All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Thursday, everybody. Today is July 3rd, 2025. Happy Jobs Day, everybody. And of course, an early happy birthday to America. Tomorrow being the 4th of July. We will not be having our show tomorrow morning as markets are closed. But the big story this morning is the jobs number. Wow. It was pretty good. It was really good. It's a lot better than anybody was expecting, especially after yesterday with that ADP private payrolls that showed, hey, maybe the jobs number was going to be kind of lousy. And then yesterday at 4 p.m., President Trump went on an anti-J-POW tirade demanding rate cuts. And everybody was saying, looks like the president got an early peek at the jobs report and it sucked. Nope, that ain't what happened. Because this morning we got the jobs report and it was really good. I mean, there's some things in there that are not so good. If you squint, you can kind of see the bad in the jobs report. And look, guys, I'm kind of a pessimist. You may have noticed I tend to focus on the bad as part of my nuclear training, just how I roll. But I got to admit, you got to look really hard to find the bad in this jobs report. So let's look at what's in there. 147,000 jobs gained for the month. That is much higher than the 110,000 that the market was expecting. It's also up slightly from the 139,000 that was reported last month. Now, you're probably sitting there saying, okay, yeah, the headline number, but Jack, what about those big downward revisions? We see it time and time again. It's how the government lies to us about the jobs numbers, and I'm right there with you. But it ain't in this jobs report. The prior 2 months were both revised higher. That's right. Who had upward revisions to the jobs numbers on their 2020s bingo card? April was revised higher by 11,000. May was revised higher by 5,000. Small adjustments, but adjustments in an upward direction still. So if you add those 16,000 upward adjustments, you're looking at a net gain of 163,000 jobs. Guys, these numbers are pretty good. Unemployment rate, last month it was at 4.2%. It was actually very close to 4.25, at which point they would have rounded up. So a lot of people were expecting the unemployment rate to jump to 4.3% this month, basically on the rounding. That didn't happen. Unemployment revised lower to 4.1%. So looks like things getting pretty well. Things getting better here. Now, some of the things that don't look so good in the jobs report, participation rate ticked down to 62.3%. That's lower than 62.4 last month. So I'm guessing that is a function of the demographic shift in the United States, our population aging out of the workforce, not enough young people aging into the workforce. That would possibly explain that. And you can kind of see that in where some of the categories are that we gain jobs. We saw big gains in healthcare. That is a function of the aging demographics in this country as well. Other areas that saw big gains was government jobs. Now, initially, I did a double take at that one. Hey, what about Doge? What about the spending cuts and all that stuff? But it was mostly state and local government jobs that saw gains. Federal government jobs down again this month. So the Doge did result in some jobs going away in the federal government, not that many, and it's being more than offset at the state level. Also, social assistance saw jobs added. So look, if you're going to squint and you're going to look for the bad in there, you've got jobs in categories that don't really reflect economic prosperity. Social assistance, social work, not really an economically prosperous field. Healthcare doesn't really add a lot of GDP. State government jobs, not really big gainers. Those were the main categories where we saw jobs added. So, if you're trying really hard to find the bad, you could focus on that. Now, within that jobs report, we've also got an addition of full-time jobs, a loss of part-time jobs. That's surprising, the reverse of the trend that we've seen for the last few months. A big spike in multiple job holders. We'll look at that one. Not such a good sign there. Self-employed, unincorporated. That's your gig workers, your Uber drivers, Lyft drivers, Door Dashers, OnlyFans girls. That actually dropped by a few 100,000. That's kind of an unusual data point there. Those numbers in the household survey kind of swung pretty wildly this month. We also got some other data we're going to look at. Initial and continuing jobless claims came out this morning. We'll look at wages. We'll look at hours as well. But guys, on the whole, you got to admit, this was a pretty good jobs report. It was a really good report. And now we've got people are starting to shift their expectations. The market had priced in some Fed rate cuts, despite the ridiculousness in D.C. and the back and forth on Twitter. There actually was several rate cuts priced in ahead of this jobs report, and now we're seeing people shift those expectations. The dollar is spiking here. The DXY moving higher. That is reflective of a less dovish Fed going forward. We saw interest rates on the 10-year yield spike. They've given up some of those gains here, higher rates. Again, market kind of resetting expectations for what the Fed might do. We saw stocks initially surged on this non-farm pay report. Everybody's like, yeah, economic prosperity. And then they're like, oh, wait a minute. That means my rate cuts probably ain't coming so soon. And we saw some of those gains evaporate just as quickly as they appeared. Now, in the opening minutes after a jobs report, markets are always very volatile. The algorithms are arm wrestling with each other. So you have to wait for things to settle down to see which direction the market is really going to take this one. But look, guys, as a guy who kind of specializes in the doomer end of things, I got to admit, this was a really good jobs number. Now, some other things going on this morning. We've got a trade deal with Vietnam was announced late yesterday. That's a big one. One of our biggest trade deficits is with Vietnam. They have become one of our biggest trading partners as a lot of manufacturing has moved out of China for several reasons. Yesterday, the Trump administration announced a deal for 20% across the board tariffs on Vietnam and 0% tariffs on U.S. imports to Vietnam or U.S. exports to Vietnam. Now, don't get too hung up on that 0% tariffs on U.S. goods. We don't really sell that much stuff to the Vietnamese, so that doesn't really matter. But the big deal in that Vietnam trade deal was this 40% tariff on transshipments, which is stuff that's basically mostly made in China, and then they either do final assembly or just repackage it in Vietnam, stamp made in Vietnam on it, and then sell it to the U.S. It's one of the ways the Chinese have circumvented tariffs. Well, there's going to be a 40% tariff on those goods. And that can actually tell us a lot about where negotiations with the Chinese are possibly going moving forward. We'll look at that one this morning. And speaking of the Chinese and the trade war, the U.S. has lifted export controls on chip software to the Chinese. That's one of those more recent trade restrictions that the U.S. had put on the Chinese in retaliation for them not shipping the rare earths they had told us they were going to ship. And then supposedly that was all settled at that London or Geneva conference, the second one. I don't remember which one came first. But as part of that deal that we made with the Chinese, we were going to lift those restrictions. They were going to start sending the rare earths. Okay, we lifted those restrictions. Still haven't gotten confirmation on those rare earths actually coming into the U.S. or not. So keep an eye on that one. I suspect we have not heard the last of the rare earth controversy. Also, we got a funny story from Robinhood yesterday. Robinhood announced a big giveaway. They were giving away tokenized shares of Openai and SpaceX. And of course, when you do a giveaway, that usually means it's promotion for something you're about to start selling. Oh my God, yeah, all right. Shares of stock trading on the blockchain. The NFT bros and the crypto guys have been all about that for so long. Yeah, we're going to expand access and all this silly talking points. And then Openai came out and said, what? No. Nobody talked to us about this. This isn't shares of our company. I don't know what this BS token is you're pumping, Robinhood, but it sure as heck does not represent an ownership interest in our company. And the rest of the world is like, what the hell is going on at Robinhood? And of course, Vlad Tenev is like, oh, we just want to democratize access to finance. And, don't worry, everybody, forget all about that time we took away the buy button on stocks because we wanted to democratize finance. Wait, how does that work? Never mind. At the end of the day, guys, these are worthless tokens. They're IOUs from somebody. If they're not actual equity shares in Openai and SpaceX, then what the hell are they? They're just an IOU from some guy somewhere. I guess you got to read the terms and conditions. I will not be getting in line to buy Robinhood's tokenized shares of Openai that are not actual shares of Openai because Openai said so. Also, office CMBS delinquency rates have risen once again. Remember that whole commercial real estate thing? That's still going on. An all-time high delinquency rate for commercial mortgage-backed securities, worse than the post-GFC spike. And it gets even worse still when you look at what's actually going on under the hood in the office CMBS sector. What a mess, and we still have not had any price discovery in that market. Got Ukraine just signed a drone production agreement with a U.S. company that I have never heard of, and there's virtually no online footprint for this company. Kind of makes me wonder, WTF is going on there? And the UK bond market is staging somewhat of a rebound this morning after Keir Starmer has doubled down on his support for their Chancellor Rachel Reeves, their finance minister. I don't know what her actual title is, the finance lady in England, who yesterday was crying in Parliament when Keir Starmer dodged the question about whether or not he was going to replace her. Now, she went on to say, oh, don't worry, it was just a personal thing. It had nothing to do with the fact that I was being humiliated on live television and that my job was just made impossible by a parliament that totally dropped the ball and fumbled on spending cuts. No, it was a personal matter. And of course, Keir Starmer came out this morning and he says, oh, no, we're not replacing Rachel. Now, here's the thing. He has to say that because if he replaces Rachel Reeves, his bond market is going to throw an even bigger fit and his pension system is going to melt down and he's going to have an even bigger problem on his hands. So the UK bond market is staging a rebound today on something that is basically, once again, the bond market ruling all. It's no different than Trump's taco trade on April 9th when he blinked on tariffs, and the bond market wins. That quote from James Carville, if he dies, he wants to be reincarnated as the bond market because it intimidates everybody. That is exactly what's happening with Rachel Reeves and Keir Starmer in the UK this morning. There is so much happening in the world once again. How about we shrink my big melon of a head and let's see what's going on in markets. Hey, don't forget that like button, and if you're new here, hit that subscribe button for the algorithm because we do this every morning so you can come back and have your coffee with the melon heads. And you can see here, guys, a little bit of movement in stocks as soon as that jobs number came out. Here's that initial spike on the jobs number. And then the market's like, oh, you know what? My rate cut's probably not going to happen. Sold off a little bit, most of those gains. And now we're kind of closer to the high than we were. A little bit of volatility here. At the end of the day, though, we're higher by 14 points or about 0.25%. The Dow, something similar, although the Dow gave up almost all of its gains here. 55 points higher, 0.12% to the upside. That would mean the NASDAQ's looking pretty good, and it is up 66 points or almost 0.3% near its pre-market highs this morning. So we've got a little bit of risk on sentiment here. That's interesting. And look at the dollar, though. That's kind of crazy. A big spike in the dollar. It's giving back some of that now, about half of it, but up 37 basis points, 97.14. We went as high as 97.41 in the moments following that jobs report. That is a resetting of Fed rate cut expectations. And looking at the bond market, we've got yields are moving higher pretty much across the board here. We had a big move in the 10-year. It's given back some of that. Right now, the 30-year Treasury is at 4.848. That's higher by 2.5 points. The 10-year is at 4.336. That's up 4.5 points. We were higher by 8 points at one point this morning. So again, we're giving back some of that initial enthusiasm. The 2 years at 3.872, higher by a little more than 8 basis points. Big move in the 2-year. And the 1 month is at 4.241. That's down by a fraction of a point. Just a reminder, guys, yields moving higher. That is bond prices moving lower. And looking over at the commodities, stronger dollar and higher interest rates, probably not so good for gold. Spot gold, $3,331-ish. That's down about $26 this morning, or about 0.75% on that news. The silver is holding up pretty well here this morning, despite a little bit of a beating in gold on that stronger dollar and higher rates. Spot silver is at $36.76 here, higher by 20 cents, or about 0.6%. I like the shiny. Watch that gold to silver ratio, guys. It's still above 90. It means silver still has room to run here, assuming gold were to trade sideways. We've got copper's lower by about 0.75%. Platinum is sharply lower this morning, 3.3%. We hit an intraday high of $1,438. Copper was looking great last night. Now it's selling off a couple of a percent here. Still at $1,384 for platinum. Platinum has had one heck of a run. Not surprised to see a little bit of selling there. Palladium is joining in, down 3%. And crude oil is off by about 0.33% here, 25 cents lower for August WTI crude futures at $67.21. Bitcoin has actually been surprisingly quiet this morning. This is kind of interesting. 109,328. We briefly touched 110,000 yesterday. Bitcoin was looking pretty good. We've been kind of hovering in this 109 and change region all morning. Did not react to the jobs number hardly at all. It's kind of interesting. Everything else was moving pretty wildly. Bitcoin, of all things, the less volatile asset this morning. Who had that on their 2020s bingo? All right. Let's look at what actually happened in the non-farm payroll. Here we go in trading economics. U.S. non-farm payrolls rose by 147,000 in the month of June 2025. That's following an upwardly revised 144,000 in May and well above forecast for 110,000. So it was a big beat here. Government employment rose by 73,000 jobs. Hardly a sign of prosperity. Namely, state government rose by 47,000, largely education, 40,000. Employment and local government education continued to trend up by 23,000. On the other hand, job losses continued in the federal government, down by 7,000 for the month. So still some job losses going on at the federal level, but not very much. That's pretty much a rounding error there. Total employment at the federal level is down by 69,000 since reaching its peak in January. Also, healthcare added 39,000 jobs, similar to the average monthly gain over the past 12 months, led by hospitals, nursing and residential care facilities. And employment also increased in social assistance. Now, again, guys, if you're really looking for the negative here, healthcare, social assistance, government jobs, these are not signs of a private sector that's doing well. Yup, we added a lot more jobs than expected, but it was in the wrong sectors. Let's just put it that way. Now they go on with the language. The June report continues to underscore the fundamentally resilient labor market. Now, one of my favorite places to look in the data is in the household survey. The numbers we were just given, that was the establishment survey. There's these two different surveys. One is business owners. The other is people and employees. Table A9 gives you a good idea of what kind of jobs are being added in the jobs report. And we usually spend some time on this one every month. In particular, full-time workers. Now, this is pretty interesting. All right, these are the seasonally adjusted numbers, mind you. Right here, you've got your numbers from May, and here's your numbers from June. So 135,277,000, these numbers are in thousands, full-time jobs. That is higher by 437,000 for the month of June. A lot of gains of full-time workers last month. And that's kind of the opposite of what we've seen for the last couple of years. That is indicative of a strong jobs market right there. Now, I would add all we really did was correct last month's decline. We're kind of right back to where we were in April. So maybe a little bit of the tariff hysteria wore off, and now we're back to where we were. Another important thing to point out here is part-time workers, seasonally adjusted. That one, 28.19 million, that is down from 28.557. So we lost 367,000 part-time jobs. So a loss of part-time, a gain of full-time. Not something we typically see here. That is, in my opinion, a healthy indicator for the job market, something we don't get a lot of lately. Something that maybe indicates the struggling consumer, multiple job holders. That's a category I watch very closely as well. Big gain in multiple job holders for the month of June, up by 282,000 to 8.865 million people working two or more jobs. That is not a sign of prosperity. That is a sign of desperation among consumers who are struggling to make ends meet. Although the silver lining here, people who want a second or third job are still able to find them. So, it's one way you could look at it. Again, not a sign of prosperity there. And the last one I like to look at is self-employed, unincorporated. Those are your BS gig work jobs that pay hardly anything. We've seen a lot of gains in that category over the last few years, and we actually had a big decline in that number. I don't know what to make out of that. Is this a flaw in the data collection? Did we really lose 338,000 gig workers last month? Did that many Uber drivers up and quit, or did that many Door Dashers stop dashing doors? I don't know. But that's a pretty profound change right there. 338,000 lost gig workers. So either way, guys, there's some good in this and some bad. The gain of full-time at the expense of part-time, that's a good sign. However, the multiple job holders and the loss of gig work, that somewhat dampens it. A couple of other data points that we got here. The unemployment rate ticked down to 4.1% from 4.2%. That's actually a little bit misleading because we were right about to hit 4.3 last month. So we actually had a pretty good decline in the unemployment rate. That is a good indicator, a healthy sign of the economy. Now, the other thing we got to talk about is the participation rate, which I thought I had that chart up here. Apparently, I did not. Let's bring up the participation rate chart. I am remiss. There we go. Participation. Come on, participation. You know you want to. There we go. All right. The participation rate in the United States ticked down to 62.3%. That is down from 62.4%. People left the workforce, stopped trying to find work. That's not a good sign. possibly a function of aging there. But that somewhat dampens my enthusiasm for that decline in the unemployment rate, because it's not more people working, it's fewer people trying to work, or at least partially explaining that. And just a reminder, guys, looking at the 5-year chart coming out of the pandemic, we have seen a decline in the labor force participation rate since its peak in the middle of 2023. And that appears to be continuing. If you look at a 10-year chart, we still have not recovered pre-pandemic levels. And it looks like we're not going to. Fewer people working than before the vid. Let's see. What else we got? Can we talk about here? Average hourly earnings. They rose again. That's a good sign. But they rose by less, up 3.7% year over year. That's after rising 3.8% last month. So still higher than the official rate of inflation, but not by all that much. And again, that's just too little too late. People trying to catch up to the loss in standard of living from prior years when inflation was running red hot. But wages still rising. That's a good sign, partially offset by this chart, average weekly hours, which ticked down to 34.2 hours a week, down from 34.3. So, all right, maybe you're making a little bit more per hour, but you're working less hours per week. So is your take-home pay really going up? It is, but very little. The loss of hours is offsetting those wage gains. And if you look, the loss of hours, that has kind of been a thing since 2021, since they started, it was in early 2022 is when they started quantitative tightening. But we've seen they've been cutting our hours pretty steadily for the last couple of years. Let's look at a 10-year chart of that, and you can see we are now lower than the average weekly hours we were working pre-pandemic. Again, there are some signs of weakness in this jobs report, even though the headline numbers and some of the full-time job numbers look pretty good. Let's look at some other data we got. Initial jobless claims came out today, not part of the non-farm payrolls, but labor data nonetheless. Another decline in initial jobless claims, 233,000, down from 237,000. So the layoffs continues to not be that big of a problem. People aren't losing their jobs that fast. Continuing claims stayed pretty high, though. Continuing claims, 1.96 million. That is basically flat from last week. So people who have already lost their jobs still struggling to get a new one. Again, it's not all unicorns and rainbows in the job market. But if you take the entirety of this labor data, guys, you have to say it was bullish. This was good jobs data. It wasn't great jobs data, but it was pretty good. That headline number, those upward revisions, the gain of full-time jobs offsetting some of the other weakness in the job market. All right, let's shift gears a little bit to what's going on in the trade war. U.S. reaches a Vietnam trade deal with a 20% import tariff, Trump says. President Donald Trump said he had reached a trade deal with Vietnam following weeks of intense diplomacy between the nations and ahead of a deadline next week that would have seen higher tariffs imposed on the country's imports. A 20% tariff will be placed on Vietnamese exports to the U.S., with a 40% levy on any goods deemed to be transshipped through the country. That's what Trump said in a social media post on Wednesday. Trump said that Vietnam had agreed to drop all levies on U.S. imports. That might look like a big win. Hey, they get 20% tariffs and no tariffs on our stuff. But then you got to remember, Vietnam imports next to nothing from the U.S., a little bit of agricultural products. So that really is just a symbolic thing there. The 40% tariff on transshipments, though, that's a big deal. The higher 40% rate announced Wednesday would be imposed on goods deemed to be transshipping, where components from China and possibly other nations are routed through Vietnam or subject to only minimal final assembly before being exported to the U.S. And that is really the big one there, because the other big goal of the trade war, besides trying to rebuild some semblance of U.S. manufacturing, has been to isolate China. And the fact that we got the Vietnamese to agree to this higher tariff on transshipping, we've actually seen a lot of transshipping. A lot of Chinese-made goods are having like the finishing touches put on in Vietnam, or just outright shipping finished products and having them repackaged in Vietnam and then sold to the U.S. as Vietnamese goods in order to get around certain restrictions. The Vietnamese have agreed to this higher rate here. Now, that is also interesting, that 40% number, because that tells us a little bit about where we might end up with the Chinese. Also in Bloomberg this morning, Trump's Vietnam deal shows China tariffs won't fall much further. They have kind of put a floor on those Chinese tariffs with that Vietnam deal. President Trump's new trade deal with Vietnam sends a clear signal about where U.S. tariffs on Chinese goods might ultimately land as talks between Washington and Beijing continue following their recent truce. Chinese goods currently face tariffs of around 55%, a level expected to remain through August. But under the latest Vietnam agreement, the U.S. will slap a 20% tariff on Vietnamese exports to the U.S. and a steeper 40% levy on goods deemed to be transshipped, the latter targeting a well-worn backdoor used by Chinese exporters since the first China-U.S. trade war in order to dodge American tariffs. By closing the loopholes, the Trump administration is signaling what any future deal with China might look like. The 40% tariff on transshipped goods suggests that even if tariffs on China are eventually reduced, they're unlikely to fall below that threshold. Again, the current levies against China are 55%. And so right now, if you're a Chinese manufacturer, it's actually advantageous for you to transship your stuff to Vietnam, repackage it, and sell it as a Vietnamese good because you can save 15% on those tariffs. So by putting this 40% tariff on the Vietnamese for transshipped goods, Trump is telling us where those Chinese tariffs are probably going to land, or at least the floor of where they're going to land once that is all said and done. And last but not least, on the trade war front, U.S. lifts chip software curbs on China in sign of trade truce. This is all about those rare earth metals. The U.S. government has rescinded its export restrictions on chip design software to China, three of the largest players in the space announced on Thursday. In separate statements, semiconductor software designers Siemens, Synopsys, and Cadence all said they received letters from the U.S. Department of Commerce informing them that the controls had been lifted. While Siemens is based in Germany, its chip design software subsidiary Siemens EDA is based in Oregon, the U.S. Let's see here. The news comes after China signaled last week that they are making progress on a trade truce with the U.S. and confirmed conditional agreements to resume some exchanges of rare earths and advanced technology. So I'll believe that when I see it. Are the rare earths actually shipping now? Well, we just lifted those curbs on the chip software. We still have export controls on the chips themselves, but the software was one of those points of contention. Those have now been lifted. Will the rare earths start flowing? We'll just have to wait and see. And in the WTF story of the day yesterday, this one was really cracking me up. Openai says Robinhood tokens aren't equity in the company, which has people saying, well, then what the hell are they? If they're selling tokenized shares of a company and the company's saying those aren't shares, then really, honestly, what is it? What drives the price of something like that? I don't know. Openai is distancing itself from Robinhood's latest crypto push after the trading platform began offering tokenized shares of Openai and SpaceX to users in Europe. The Openai tokens are not Openai equity, Openai wrote on X. We did not partner with Robinhood. We're not involved in this and do not endorse it. The company said that any transfer of Openai equity requires our approval. We did not approve any transfer and warned users to please be careful. Robinhood announced the launch Monday from Cannes, France, as part of a broader product showcase focused on tokenized equities, staking, and a new blockchain infrastructure play. The company's stock surged above $100 to hit new all-time high following the news. Who in their right mind is buying Robinhood stock on this BS? When they're offering shares of a company and the company comes out and says those are not our shares, and yet people still run out and buy the stock. This market will buy anything. These tokens give retail investors indirect exposure to private markets, opening up access, and are enabled by Robinhood's ownership stake in a special purpose vehicle, a Robinhood spokesperson said in response to OpenAI's post. And I tell you, Wall Street and they're like, they love to talk about democratizing finance and opening access to the average person every time they're selling crap. That's what they do. So I am not running out. I mean, this is illegal to offer these in the U.S. At least the SEC is doing something here. I don't know why this crap is legal in Europe, but this is fraud. They're offering shares, tokenized shares in a company, and the company is flat out saying these are not shares in our company. So what are they? They're just tokens with the word OpenAI slapped on it and a whole bunch of legalese that probably protects Vlad Tenev and his fellow crooks from any kind of legal obligations. All right. Hey, commercial real estate. Anybody remember that? That's still going on. Office CMBS delinquency rate spikes to a record 11.1% in June, worse than the financial crisis meltdown peak after a 3-month relapse. The delinquency rate of office mortgages that have been securitized into commercial mortgage-backed securities spiked to 11.1% in June. That's a new all-time high, re-blowing past even the financial crisis meltdown high and squeaking past the December 2024 high, according to data by TREP, which tracks and analyzes CMBS. Since the beginning of 2023, the delinquency rate for office CMBS has exploded by 9.5%. And so the depression in the office sector of commercial real estate drags on, despite well over a year of pronouncements that the worst is behind us. Somebody get Barry Sternlicht on the phone at CNBC so he can come on the air and tell us the floor is in once again. That'd be like the 30th floor this year, but I digress. The last 3 months were a majestic relapse from February and March, when the delinquency rates seem to be on the mend. And here's that little, if you squint, you can see it in the chart. Here's a bigger version of the chart. There's that, what do they call it? A majestic relapse. Yep, we ticked down for 2 months, and then that's it, right back up to an all-time high. This is in Wolf Street this morning, by the way. Now, here's why it's even worse. What actually happened within these delinquencies? A total of $156 billion of office loans have been securitized, Trepp said. The CMBS were sold to institutional investors, such as bond funds, insurers, but banks are largely off the hook here. The big banks don't have a lot of exposure. Some small and regional banks have a lot of exposure, but this is not necessarily a big bank problem. In June, $1.8 billion of these CMBS office loans became newly delinquent, including the three discussed below, while $1 billion of delinquent office loans were cured and came off the list. Now, here's the thing. Cured and came off the list. What actually happened? One of those cured loans, the court transferred the property into a receiver, which means they're about to foreclose on the property. The receivership is one step ahead of foreclosure. Another was cured by extend and pretend, which means they haven't paid anything. They just extended the loan, just basically tacked it on to the end. And that was $1 billion of these loans came off the delinquency list via those methods, which means the office delinquency rate should have gone up even more. And the actual true delinquency rate is even worse than this chart would reflect. But because of extend and pretend and because of foreclosures, they're kind of sweeping some of that under the rug. The newly delinquent balance rose by $800 million. That's the difference between the $1.8 billion in new delinquencies and that $1 billion of, air quotes, cured loans. This one in Reuters this morning, this one has me scratching my head. Ukraine signs drone production agreement with a U.S. company, Zelensky says. And you have to look at this in the context of what happened yesterday with a lot of those weapons packages, the missiles, the Stingers, and the Patriots and Hellfires. They were all hung up in Poland yesterday. And then today we've got this big production agreement with this U.S. company, and it's this company nobody's ever heard of. Ukraine has signed an agreement with American company SwiftBeat to produce hundreds of thousands of drones this year, President Volodymyr Zelensky said on Thursday. Interceptors for destroying enemy drones and missiles, quadcopters for reconnaissance and fire adjustment, long-range strike drones. There will be much more of all of this, he wrote on social media during a trip to Denmark. I went to look up this SwiftBeat company, and I got a whole bunch of Taylor Swift crap in my search results. I don't know who these guys are. Are they a subsidiary of somebody? Are they a new player in the space? When I heard Ukraine had signed a drone agreement, my initial reaction was this is probably Anduril, but it wasn't. It's this SwiftBeat outfit. I don't know who the heck these guys are, but they're going to be making a lot of drones for the Ukrainians a day after the Ukrainians didn't get a whole bunch of missiles that they were supposed to be getting from us. Probably more to this story than is included in this article. And last one of the day, guys, check this one out. UK markets rebound as Starmer quashes fears of a Reeves exit. And I don't think this is really such great news. I think Starmer was forced to do this because his bond market was freaking out. UK markets rebounded from a sharp sell-off as Prime Minister Keir Starmer sought to calm speculation about a possible exit by Chancellor of the, how do you even say that? The Exchequer, Rachel Reeves. Somebody let me know how to pronounce that. Exchequer, I don't know. Bond currency and equity markets recovered some of their losses from a slump triggered by concern a new chancellor might usher in increased borrowing. In a BBC interview late Wednesday, Starmer gave Reeves his full backing, and the chancellor later reiterated the government's commitment to its fiscal rules in an unscheduled TV appearance. The yield on 30-year bonds fell as much as 12 basis points to 5.3% after a 19 basis point jump on Wednesday, the biggest increase since April. The pound-led group of 10 gains and stocks climbed on a down day for most of European equities. The market has been really reassured by Keir Starmer's words, said Henry Allen, a macro strategist at Deutsche Bank. Now, look, guys, Starmer had to do this. When he was asked in Parliament if he was going to replace Rachel Reeves, he dodged the question. He gave this long-winded non-answer. Rachel Reeves is sitting behind him crying in Parliament, and the bond market starts to freak out. Everybody started dumping UK bonds because the fact that Starmer was even entertaining the idea of replacing Reeves suggested the UK government was going to start borrowing even more money to pay for the lack of cuts to welfare that had just been taken out of this reform bill. And so everybody was freaking out in the UK bond market yesterday. Keir Starmer had to come out and say, no, we're not going to fire Rachel. He was forced to. His bond market made him do it. And of course, when he did it, you're looking at the yield on the UK 10-year gilt. And it's these two candles right here you got to focus on. Big move yesterday. This was the market freaking out on that reaction, on the prospects of replacing Reeves. And then Starmer comes out and says, no, we're not going to replace Rachel. Don't worry. She's going to be here. You don't have to cry, Rachel. Reeves insisted it was a personal matter. It probably was not. And it looks like the yield on the UK 10-year gilt gave up about half of those gains. So there was a little bit of gilt buying afterwards. Yields remain sharply higher than they were before this fiasco. I suspect the end is not, or that this is not the end of this story. They bought themselves a couple of months. At the end of the day, Rachel Reeves still has to figure out how she's going to pay for all this crap without borrowing more money. Money has to come from somewhere. I don't care what your Keynesian textbook tells you. You either got to tax it or you got to borrow it. That's where it's got to come from. They already raised the taxes and all the millionaires left England, so that's not working. If you borrow it, the bond market's going to freak out. The only way to avoid that is if you borrow it and your central bank prints it and lends it to you. Well, then you better get ready for higher inflation expectations, which might take your interest rates higher. Anyway, at the end of the day, you got to cut the freaking spending. That's what it comes down to. Are they going to cut spending? Almost certainly not. And I just want to say thank you very much to the Pasta Man. What's going on, Nashville? He says 30,000 Microsoft layoffs, 3 months. So glad someone is hiring. Yeah, someone is hiring. It's the local government, it's hospitals, and it's schools. That's who's hiring. That's not going to replace big tech jobs, well-paying big tech jobs. Also, shout out to the jobs chick, Amanda Goodall, who pointed out on Twitter that Microsoft is laying off people in the U.S. and at the same time filing for thousands of H-1B visas so that they can hire cheap immigrant labor to replace them. Yeah. Thanks, but no thanks, Microsoft. Thank you so much, Pasta Man, for supporting the channel. Somebody is hiring out there. I'm not really sure who it is. And hey, Pasta Man is back again with the same thing. Did you? Uh-oh. What happened, Pasta Man? Did you fat finger that comment twice, or are you just being a swell guy saying the same thing twice? Either way, I reiterate my thanks for the support of the channel. Hey, Chris Bott. What's going on, Chris? He says, I'm selling tokens of my Beanie Babies and Pogs. Someone want to tell me what a Pog is? Am I behind the times? Is a Pog like a Beanie Baby knockoff? I don't know. But yeah, okay, tokenized Beanie Babies. Now we're thinking outside the box. How about, I've got the whole melon coin thing going. I don't really have a crypto. I'm going to sell tokenized tokens. How about that? Why don't we tokenize the tokens? We'll call them synthetic token transfers or STTs. I don't know. We'll figure something out there. I didn't really think that out too much. But yeah, I get the point here. Like, what is Robinhood even doing? They're making up fake shares of a company. The company's like, no, these aren't our shares. And people buy the stock on this crap. Robinhood shares go above 100%. Oh my, no, we do not need rate cuts. We definitely don't need rate cuts if that's happening. We need rate hikes and QT like you wouldn't freaking believe. We need price discovery, guys. If this kind of crap is still selling, then there's just too much freaking money sloshing around in the system. Thank you, Chris, for the laugh and for supporting the channel, sir. Madison Hypes says, what's the new hedge to stocks if bonds are out? Madison, I can tell you, I still own T-bills. I don't own long duration stuff. I'm still sitting in a lot of cash. And while I'm sitting in that cash, again, I can't tell you what to do with your money. I can only tell you what I do with mine. I park it in 1 month, 3 month, 6 month T-bills. I got a little bit of a ladder. So every month I have a little bit that is maturing and I get another look at it. I can either pull the cash out and go buy something or I just reinvest it. So I'm still sitting in a little bit of T-bills, and Treasury bills are at least keeping up with inflation for the time being. Beyond that, I own a lot of gold, a lot of silver, and a lot of Bitcoin. And I've been largely out of stocks since 2022. Stocks have done very well, but metals and Bitcoin have done very weller, even better. So I'm happy with my current allocation, and I see nothing in the equities market to suggest that there's anything resembling price discovery returning to this market anytime soon. So I'm going to continue with that allocation. I am very cautiously positioned. You could say my Bitcoin holdings, which is my biggest position now, not on purpose, just Bitcoin went up so much. That's pretty aggressive. I am looking to reduce my Bitcoin exposure over the next few months because I think crypto winter probably a few months away at best. Thank you, Madison, for supporting the channel. Stacy Taylor. Hey, Stacy. And there's Gigi the dog in the picture. Long time no see, Stacy. Good to see you. I hope you and Chris are doing well. He says, using AI to create self-employment jobs, ideas. AI to create them. All I can tell you is AI is a useful tool, Stace. I use it. I use it to help with titles. I use it to help with keywords. I use it to game out hypothetical scenarios. Sometimes what would happen if a certain percentage rise in this, what would happen in other sectors of the economy. But even that, everything AI tells you, you have to double check because it just spits out wrong information way too frequently. And if you go like build a job or build a business that just mindlessly spits out what AI gives you without any human double checking, you're going to screw your customers and you're going to go out of business real fast. So I'd say no matter what business you're in, you should be looking at ways to use AI to streamline your process and to increase your productivity, but don't rely on it. If you rely on it, you're setting yourself up for failure. That's the best thing I could tell you there. I was using AI just the other day to come up with hypothetical scenarios for trading the gold to silver ratio, certain thresholds. If the GSR goes above this threshold, okay, we're going to buy more silver. We're going to trade gold for silver if it goes below this threshold. And I asked it to backfit that data going all the way back to 1980. What would the average return be? How would that have compared with the S&P 500? And I was gaming a couple of different scenarios where that might play out to see what the right levels were. So, I mean, that's how I use it. And that was pretty useful. Actually, most of those scenarios outperform the S&P 500, even when accounting for compounding dividends. Just one more thing to reiterate. None of us owns nearly enough gold for what's coming. Thank you, Stacy, for the super chat. And it's good to see you. Thank you very much. Appreciate that. Steve Woida says, tinfoil hat. You know what? We haven't put this on in a while, Steve. All right. Tinfoil hat time. There it is. Commercial mortgage delinquency news depressed in MSM. So large hedge funds institution can dump it on investors. They're trying like hell to dump it on investors. And that is probably where a lot of it has ended up in pensions and insurance funds. But even a lot of them aren't really touching it. A lot of this stuff's just going up in smoke here. Extend and pretend is happening. Then when you extend and pretend, all you're doing is delaying the loss. You're not really selling it. The lender is just being forced to agree to these new terms because the alternative is to seize a building that is not worth anywhere near what you lent that person to buy on it. And then when you seize the building and resell it, you're going to realize that loss. So it's not so much, a lot of it has been sold to investors, but the point is the losses are hiding on the balance sheets of the funds that currently own the stuff. And they're jumping through a lot of hoops. They're doing this dance to try to avoid realizing that price discovery, hoping somehow the Federal Reserve rides to the rescue, or maybe this office to residential thing finally gets gets its feet under it. But it's not so much where are they selling it, is where are those losses hiding? And I think a lot of it is ETFs, a lot of it is real estate investment trusts, insurance funds, and yes, pension funds are sitting on a lot of the stuff, probably university endowments too. Thank you, Steve, for supporting the channel. And yes, the MSM was very quiet about those higher delinquency rates. I mean, when I went looking for that story, because I knew the data came out, Wall Street had the best coverage of it. Very little in Bloomberg or CNBC or any of those sell-side research media outlets. Thanks again, Steve, for supporting the channel. Dan Hedin says, losing your job equals a personal matter. That is one way to look at it. Talking about the Rachel Reeves story yesterday. Yeah, She was very upset over a personal matter, probably the fact that personally she was ruined when she is going to be forced to resign. But again, that's not happening. They need to keep her in the job, because if they force her out or if they replace her, they're signaling to the bond market that they're going to borrow more money, and that means interest rates are going to rise, and they can't afford for that to happen. So Keir Starmer was forced by his bond market to keep Rachel Reeves, which means all they've done is delay those spending cuts that they are being forced to make. Bond vigilantes won that round, is what it looked like yesterday with the UK. Now, we'll see ultimately what happens. It's probably going to be a few more months before we find out where they're going to try to make up for the spending cuts that they didn't follow through on. But it's got to come from somewhere. It sure as heck ain't going to come from defense. Europe is spending like drunken sailors on military now. Thanks again, Dan, for supporting the channel. M&J, what's going on, M&J? She says, you put on the hat, so now I have to super chat more merch. M&J still wants the merch. Merch remains on the list, M&J. I just need to find a vendor I trust. Unfortunately, the people who made this, well, they're dirtbags. They owe me money. They owe people hats. And unfortunately, I just don't think they're gonna resolve that. Hey, by the way, Spring, you still owe me money. Yeah. All right. Anyway, pays to be a dirtbag. What can I say? The degenerates make money. That's how it happens. Yeah, it's on my list. There will be more merch at someday, and the dirtbaggery shirt that you are owed is coming, M&J. And by the way, M&J, thank you so much for everything you do for the channel, both as a moderator and for supporting the channel with super chats and the memberships you donated yesterday. While we're on the subject, thank you also to Mission Nan and all my other mods for everything you guys do for the channel. Appreciate it very much. Being a moderator is a thankless job, and they do it very well. And I just want to say thank you, everybody, for having your coffee with the Melonheads this morning. Appreciate that very much. Don't forget that like button and subscribe button on the way out for the algorithm, should you feel so inclined. Just a reminder, guys, no show tomorrow for the 4th of July holiday, and we are once again moving the Patreon Zoom to Sunday night because of the holiday as well. I'll be posting that link shortly. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.